What I'm about to show you in this video is something that affects roughly half of all Social Security recipients in America right now, and most of them have absolutely no idea it's happening to them. There is a specific IRS Formula 1 that has existed since 1983, one that has never once been adjusted for inflation, and one that uses a calculation most Americans have never seen or heard of that silently determines how much of your Social Security benefit gets taxed every single year. It's called provisional income. And the reason it's so impactful and so overlooked is that it doesn't work the way people expect. The thresholds that trigger taxation of Social Security benefits are not indexed for inflation. In 1983, when this rule was first written, those thresholds captured roughly the top 10% of Social Security recipients. Today, because incomes have risen with inflation over 4 decades, while the thresholds have sat completely frozen, that same formula now captures roughly the top 50%, half of all Social Security recipients, paying federal income tax on their benefits, because of a rule that was originally designed to apply to only 1 in 10. And the kicker? There are completely legal, IRS-approved strategies that can reduce or even eliminate this tax burden. Strategies that thousands of retirees are using right now, but only if they know about them. That's what we're covering today, every single detail. So stay with me to the end. Welcome to Professor Kingsley, the channel built for everyday Americans who want to understand the tax and financial rules that matter most in retirement, explained clearly, honestly, and without any of the complicated jargon that makes most people's eyes glaze over. If you're new here and you want to stay on top of the rules that directly affect your retirement income and financial security, please hit that subscribe button right now and turn on the notification bell. We put out new content every single week, and when something changes in the tax code, or when something like today's topic has been sitting unaddressed in millions of retirement tax returns for years, you deserve to know about it. So subscribe, and let's get into the most important thing I'm going to tell you today. Let me start by explaining the provisional income formula in plain English, because once you understand it, everything else falls into place. The IRS uses a special measure called provisional income, also called combined income, to determine how much of your Social Security benefits are taxable. It is not the same as your adjusted gross income. The formula adds back certain items that would otherwise be excluded from income. Provisional income equals your adjusted gross income, excluding Social Security benefits, plus any tax-exempt interest income you received, plus 50% of your total Social Security benefits. Let me say that again in the simplest possible way. You take all your income from every source your IRA withdraws, your pension, any wages, dividends, capital gains, and you add to that any interest from tax-exempt bonds. Then you add half of your Social Security benefit on top. That total is your provisional income, and that number determines whether 0, 50%, or 85% of your Social Security check gets added to your taxable income. For single filers, below $25,000, none of your Social Security benefits are taxable. Between $25,000 and $34,000, up to 50% of your benefits may be taxable. Above $34,000, up to 85% of your benefits may be taxable. For married couples filing jointly, below $32,000 is the zero tax zone. Between $32,000 and $44,000, up to 50% is taxable. Above $44,000, up to 85% may be taxable. And here's the critical fact that I need you to really absorb. These thresholds are not adjusted for inflation each year. They only change when Congress specifically acts to raise them. The limit of $25,000 for single filers has remained unchanged since 1983. The $34,000 threshold for the 85% tier was set in 1993 and has never moved. For this reason, as Social Security benefits rise each year through cost of living adjustments, and as retirement account withdrawals naturally grow over time, more and more retirees find themselves pushed further into taxable territory, not because they got wealthier, but simply because the ruler hasn't moved in decades, while everything measured against it has grown. This is the overlooked IRS rule. Not a complicated loophole, not a hidden tax shelter, just a formula that has been quietly collecting more and more money from more and more retirees for 40 years, with very few people understanding how it works or what they can do about it. Now let's make this completely real with a concrete example, because I want you to feel the impact of these numbers in your own situation. Let's say you're a single retired person. Your Social Security benefit is $24,000 per year, close to the current national average. You also take $20,000 from your traditional IRA each year to cover your living expenses. Using the provisional income formula, your combined income would be $20,000 in IRA withdrawals, plus half of your $24,000 Social Security benefit, which equals $12,000. That gives you provisional income of $32,000, well above the $25,000 threshold for single filers, putting 50% of your Social Security benefits into taxable income. That means $12,000 of your Social Security check is now taxable income. If you're in the 12% federal bracket, that's roughly $1,440 in federal income taxes on money you already paid into the system your entire working life. But now here's where it gets worse. If that same single retiree withdraws an additional $10,000 from their IRA, their provisional income rises to $37,000, crossing the $34,000 threshold that pushes up to 85% of their Social Security into taxable income. So a $10,000 increase in IRA withdrawals doesn't just add $10,000 in taxable income, it also makes an additional portion of their Social Security taxable. The true tax cost of that extra $10,000 withdrawal can be far higher than the stated bracket rate suggests. In some cases, those in the 22% federal income tax bracket could end up paying a marginal tax rate as high as 40.7% because additional household retirement income causes more of their Social Security income to become taxable. Tax professionals call this the tax torpedo, a zone in the retirement income range where your effective tax rate on each additional dollar is dramatically higher than it appears. You think you're paying 22% on that extra IRA withdrawal. You may actually be paying something much closer to 40% when you account for the additional Social Security taxation it triggers. This is why managing provisional income isn't just a nice-to-have in retirement planning. For a huge number of retirees, it's the single most impactful tax strategy available. Now here's where the video gets good. Because once you understand the formula, you can start engineering your income to stay below the thresholds, or at least to minimize how deep into taxable territory you go. And the strategies for doing that are legal, IRS confirmed, and available to you right now. The first and most powerful strategy is the one that has been a centerpiece of conversations on this channel, the Qualified Charitable Distribution, or QCD. Taxpayers age 70 and a half or older can make qualified charitable distributions directly from their IRA to a qualified charity. QCDs satisfy required minimum distributions but don't count as taxable income. They don't appear in adjusted gross income at all, and because they're excluded from AGI, they don't enter the provisional income formula either. This is enormously powerful in the context of what we've been discussing. Every dollar you distribute from your IRA as a regular withdrawal adds to your AGI and therefore adds directly to your provisional income. But a QCD bypasses AGI entirely. The money goes directly from your IRA to the charity. The RMD is satisfied. The IRS registers the distribution, but it never hits your taxable income, and it never raises your provisional income. For a retiree who is charitably inclined and who is also trying to manage their Social Security tax exposure, this is the cleanest, most effective tool available. Using Roth withdrawals during high-income years is another key strategy. If you already have Roth savings, using Roth funds instead of IRA or 401k withdrawals helps keep AGI and combined income lower and can reduce or eliminate Social Security taxation. Roth withdrawals do not count toward combined income. This is the long game of retirement tax planning. Every dollar you converted from a traditional IRA to a Roth in the years before you claimed Social Security, especially in those lower income years right after retirement when your bracket was at its most favorable, is a dollar that you can now pull out in retirement without it touching your provisional income. Roth distributions are completely invisible to the provisional income formula. They're not in your AGI. They don't raise your combined income. They don't make one additional dollar of your Social Security taxable. They are, from a provisional income perspective, the cleanest possible source of retirement income. The second set of strategies involves careful management of the timing and amount of your traditional IRA and 401k withdrawals. Because as we saw in our example, these withdrawals flow directly into AGI and directly into provisional income. One effective way to use provisional income management is through careful timing of income. Consider spreading larger withdrawals across multiple tax years. If you take one substantial distribution, it could push you into a higher tax bracket and a higher Social Security taxation tier. This approach helps maintain your provisional income at lower levels year over year. Spreading IRA distributions is especially valuable before required minimum distributions begin. Every dollar you withdraw from a traditional IRA goes straight into your AGI and therefore into your provisional income calculation. This creates a multiplier effect, where a $10,000 IRA withdrawal may effectively cost you far more than the stated tax rate implies because of the additional Social Security taxation it triggers. This is why tax planning before RMDs begin is so valuable. Roth IRA conversions are a powerful tool to manage Social Security taxation, but only if done at the right time. The optimal window is the years between retirement and Social Security claiming, when earned income has dropped and you may be in a lower bracket. Here's the practical picture. The years between when you retire and when you start taking Social Security, and then between Social Security and when RMDs begin at age 73. Those are the years when deliberate, strategic Roth conversions have the most leverage. You're converting at a lower income level, paying a lower tax rate, and permanently removing those dollars from future provisional income calculations. Every dollar moved to Roth before your RMDs kick in is a dollar that, in all the future years of your retirement, cannot push your Social Security into taxable territory. Now let me address something that trips up a significant number of retirees, and that is the municipal bond trap. A lot of people buy municipal bonds specifically because their interest is exempt from federal income tax, and that's a real benefit in many contexts. But in the context of the provisional income formula, municipal bond interest creates a specific and costly problem. Tax-exempt interest income, including interest from municipal bonds and bond funds, is added back into the provisional income formula. It is added back specifically because Congress did not want tax-exempt interest to create a loophole for avoiding Social Security taxation. The amount of your tax-exempt interest appears on Form 1040, line 2A, and it goes directly into the combined income calculation. Let me make this concrete. You have $200,000 in municipal bonds earning 3.5% interest. That's $7,000 per year in tax-exempt interest income. You don't pay federal income tax on that $7,000. But that $7,000 goes directly into your provisional income calculation. At an $11 impact per $1 of additional provisional income because of the 85% Social Security taxation tier, that $7,000 in tax-free interest may actually be making $5,950 more of your Social Security benefit taxable. Depending on your tax bracket, the net tax cost of holding those municipal bonds could be significantly higher than the interest rate would suggest. High-income retirees may find that municipal bonds inadvertently increase Social Security taxation, making them a less tax-efficient choice than they appear on the surface for people in the 85% provisional income tier. This doesn't mean municipal bonds are always a bad idea in retirement, but it does mean that their true tax cost needs to be calculated holistically, including how they affect your provisional income, and therefore how much of your Social Security benefit becomes taxable. This is a calculation that most people never make. Now let's bring in the newest development in this space, because the One Big Beautiful Bill Act of 2025 added a tool that interacts with provisional income management in an important way. For tax years 2025 through 2028, taxpayers who are age 65 or older may be eligible to claim an additional $6,000 deduction per person, $12,000 if married filing jointly and both spouses are eligible. It is available to eligible taxpayers who claim the standard deduction or itemize. The deduction phases out for taxpayers with modified adjusted gross income over $75,000 for single filers and $150,000 for joint filers. The new $6,000 senior bonus deduction may help retirees stay below taxable income thresholds through 2028. It is one of the strategies available for minimizing Social Security taxation, alongside Roth conversions, managing withdrawals, and timing capital gains. But here's the nuance that I want you to understand clearly, because it's a source of genuine confusion for a lot of retirees right now. The new senior bonus deduction for older adults is a below-the-line deduction. This means it reduces taxable income, the number on which your actual tax bill is calculated, but it does not directly reduce adjusted gross income or the provisional income formula. In other words, the $6,000 enhanced senior deduction will reduce the tax you pay on whatever taxable income you have, including whatever portion of your Social Security is taxable. But it won't reduce the provisional income number that determines how much of your Social Security is taxable in the first place. For that, you need the above-the-line strategies QCDs, Roth conversions, and strategic withdrawal timing that actually reduce AGI before the formula is applied. Both matter. The below-the-line deduction reduces your tax bill. The above-the-line strategies reduce the income that gets taxed. Used together, they produce the most comprehensive protection of your retirement income available under current law. Let me now address a specific misconception that has been circulating widely since the One Big Beautiful Bill was signed, because it's causing real harm to retirees who are making planning decisions based on incorrect information. You might have heard that the One Big Beautiful Bill eliminates taxes on Social Security benefits. It does not. The new law doesn't change the Social Security benefit tax formula or the IRS combined income thresholds. The formula is unchanged. The thresholds are unchanged. The rules governing what counts toward provisional income are unchanged. What changed is the addition of the $6,000 enhanced senior deduction and the extension of the current tax brackets. Both are meaningful benefits, but if you are a retiree who believed or was told by someone that Social Security is now tax-free because of the new law, please correct that understanding immediately. Because if you've adjusted your withholding, your estimated payments, or your withdrawal strategy based on that incorrect assumption, you could be heading toward a surprise tax bill. The IRS will continue to use the same formula it has used for the past 40 years to determine how much of your Social Security income is taxable. The income thresholds have not been adjusted for inflation throughout the entire period. The formula that in 1983 applied to the wealthiest 10% of Social Security recipients continues to widen its reach with each passing year, and the responsibility for managing it remains with you. Let me also quickly cover two more things that are worth knowing about in the current IRS environment, because they connect to this same theme of protecting retirement income. The first is the new standard deduction amounts for 2026, which affect how much income you shield before any tax applies. For 2026, the standard deduction is $32,200 for married couples filing jointly and surviving spouses, $16,100 for single filers and those married filing separately, and $24,150 for heads of household. A higher standard deduction could reduce taxable retirement income for filers who do not itemize. When you stack the 2026 standard deduction on top of the existing senior additional deduction and the new $6,000 enhanced senior deduction, the total deduction package for a qualifying senior is substantial, and it means more income is shielded from tax before rates ever apply. The second thing to know is about state taxes on Social Security, because the federal picture is only part of the story for some retirees. Only 9 states tax Social Security benefits in 2026, and most offer income-based exemptions. West Virginia completed its phase-out of Social Security taxation in 2026, meaning all Social Security benefits are now fully exempt on 2026 returns filed in 2027. If you live in one of the remaining states that still taxes Social Security, that's a legitimate factor in your overall tax planning, and for retirees considering relocating, it's a meaningful financial consideration worth modeling before you move. Now let me give you the action plan that pulls all of this together, because information is only valuable when it leads to action. Step 1. Calculate your provisional income right now. Add your AGI from all sources except Social Security, plus any tax-exempt interest you receive, plus half of your annual Social Security benefit. Compare that total to the thresholds for your filing status. Know where you stand. If you're already in the 85% tier, you need the strategies we've discussed urgently. If you're in the 50% tier, there may be room to manage your income down below the $25,000 or $32,000 floor and eliminate Social Security taxes completely. Step 2. If you are 70 and a half or older and you give to charity at all, initiate a qualified charitable distribution from your IRA instead of donating from your checking account. This directly reduces your AGI, reduces your provisional income, and keeps more of your Social Security from being taxable, all while fully satisfying your charitable intent and counting toward your RMD. Step 3. If you are in the gap between retirement and age 73 when RMDs begin, seriously evaluate Roth conversions. The window is limited. The benefit is permanent. Converting traditional IRA dollars to Roth now at your current lower income level removes those dollars from future AGI, future RMDs, and future provisional income calculations for the rest of your retirement. Every dollar converted is a dollar that can never push more of your Social Security into taxable territory in the future. Step 4. Be deliberate about the size and timing of your IRA withdrawals each year. Know what your provisional income will be before you take a large distribution. Understand the multiplier effect that additional IRA withdrawals create on Social Security taxation. Spread distributions across years when possible to stay in a lower provisional income tier. Avoid taking large lump sum distributions that push you into the 85% zone in a single year if it can be avoided through planning. Step 5. Make sure the $6,000 enhanced senior deduction is being claimed on your 2025 tax return if you are 65 or older and your modified adjusted gross income is below the phase-out threshold. Verify it's on Schedule 1A. Ask your preparer directly. Don't assume. And Step 6. Have a tax planning conversation with a qualified professional, not just a tax filing conversation. There's a difference. Filing is about capturing the current year. Planning is about positioning the next 5 years. Given the provisional income formula, the Roth conversion window, the QCD strategies, and the temporary enhanced senior deduction that expires in 2028, there is a lot of value-creating planning that can be done right now by the right advisor for the right retiree. Before we wrap up, I want to say this directly. The provisional income formula is one of the most consequential rules in all of retirement tax law, and it is one of the least understood. The IRS doesn't send you a letter explaining that half of your Social Security is now taxable. It doesn't alert you to the multiplier effect that additional IRA withdrawals create. It doesn't tell you that the same bond interest you thought was tax-exempt is quietly adding to your combined income and making more of your Social Security taxable. It just calculates, collects, and moves on. The burden of understanding and of managing your income intelligently is entirely on you. You now understand this better than most retirees in America. Use that knowledge and help someone else use it too. Before you close this video, please share it with one person, a friend, a sibling, a parent, a neighbor who is retired or approaching retirement and who is probably paying more tax on their Social Security than they need to be. Hit the share button right now. It takes 3 seconds and it could genuinely save them real money. And drop a comment below. Tell me, did you know about the provisional income formula before today? Have you been in the 85% tier without realizing it? Are you currently working with any of the strategies we covered? QCDs, Roth conversions, careful withdrawal timing. Tell me where you are in your planning. I read every single comment, and your situation helps me understand what to dig deeper on in future videos. This is Professor Kingsley. Protect your income, stay informed, and I will see you in the next one.